What if the most brutal sell-off in silver's recent memory was not a defeat, but a detonation aimed at the wrong target? What if the people who pulled the trigger on silver last week just handed the buyers beneath the market exactly the discount they were waiting for? Stay with me, because by the end of this video, you will understand why Tuesday may be the day the dumpers discover they made the most expensive mistake of 2026. There are moments in markets, rare, vertiginous moments, when the machinery of finance appears to operate in open defiance of the physical world it was designed to reflect. We are living through precisely such a moment in silver, and the implications of what has unfolded over the past several days carry consequences that extend well beyond the trading screens where panicked liquidations have commanded the headlines. Let us begin with the facts, because facts are stubborn companions even when the crowd prefers the comfort of hysteria. Silver, which surged more than 147% in 2025 and briefly pierced the previously unthinkable threshold of $121 per ounce in January of this year, has since been subjected to a selling campaign of remarkable ferocity. The January crash, an intraday collapse of more than $47, from $121 to the mid-70s, was, by one calculation, the worst single session for silver since 1980. The Federal Reserve's hawkish pivot at its June FOMC meeting, which left rates unchanged while 9 of 19 policymakers quietly penciled in a rate hike by September, sent the dollar toward a one-year high and silver toward the $63 range in the days that followed. But wait, before you conclude this story, ask yourself one question the headlines have not asked. Is a falling price the same thing as a broken market? The answer, examined with any intellectual seriousness, is no. And the distinction matters enormously because the silver market of 2026 is not the silver market of 1980, nor of 2011, nor of any prior episode to which casual analysts reflexively reach for comparison. The structural architecture has been fundamentally altered, and the sell-off, however violent in its optics, may have done nothing whatsoever to address the underlying imbalance. According to the Silver Institute, 2026 is projected to mark the sixth consecutive year of global silver supply deficit, a deficit estimated at 46.3 million ounces, wider than the year before. Let that number settle for a moment. 6 consecutive years. A cumulative shortfall, by industry estimates, of roughly 820 million ounces between 2021 and 2025, approximately equivalent to 1 full year of global mine production, has been quietly drained from the above-ground inventories that once served as the market's buffer and shock absorber. Those buffers are not infinite, and the recent dump did not create a single new mine, refine a single additional ounce, or convince China to reverse its January 2026 export restrictions that effectively severed 60 to 70% of globally traded refined silver from the international market. What you are witnessing, in other words, is a collision between the paper world, futures contracts, leveraged positions, margin calls, algorithmic selling, and the physical world, which operates on geological timelines, not trading timelines. CME Group's decision to shift silver margin requirements from fixed dollar to percentage-based calculations at precisely the moment liquidity was thinning was, by the account of multiple market analysts, the mechanical trigger that cascaded leveraged traders into forced liquidation. They were not selling because they believed silver's fundamental story had changed. They were selling because the leverage had become too expensive to maintain. And that distinction is not a minor technicality. It is the entire story. Here is something the panic-driven commentary will not tell you. When margin requirements are raised aggressively and paper traders dump their COMEX contracts, they are not selling actual metal. They never owned any metal. The physical ounces sitting in solar panels, in electric vehicle connectors, in the circuit boards of AI data centers, in the medical equipment of hospitals across the world, none of that metal went anywhere. The chart fell. The metal did not disappear. Think carefully about what that means. And now ask yourself, if Tuesday opens and silver refuses to continue lower, what does that tell you about who actually holds the stronger hand? The question before every serious observer of this market is not whether the sell-off was painful. It was. It is not whether short-term momentum has shifted. It has. The question is whether the sellers have done enough damage to extinguish the physical demand that has been building for half a decade beneath the surface of this market. And the early evidence, examined without the distortion of either panic or promotional enthusiasm, suggests they have not. COMEX registered inventories, the metal actually cleared and available for delivery, have fallen approximately 75% from their 2020 peak. London silver lease rates, which historically sit between 0.3 and 0.5% for one-month contracts, spiked to levels not seen since the Hunt Brothers episode of 1980. These are not the hallmarks of a market drowning in surplus. These are the symptoms of a market being stretched to its structural limits, while the paper price is simultaneously being driven lower by mechanical forces entirely disconnected from supply and demand. And that, with precise deliberateness, is why Tuesday matters. Not because one session resolves a structural argument that has been building across 6 years of consecutive deficits, but because the first reaction, after a violent emotional sell-off, is frequently the market's most honest statement about where the genuine balance of power resides. If sellers can maintain their grip and drive prices through recent support on Tuesday, the conversation changes. If they cannot, if silver absorbs the pressure and begins to reclaim lost territory, then the dump may have accomplished something its architects never intended. It may have created, at considerable institutional expense, precisely the springboard from which the next move launches. If this analysis is connecting with you, if you believe understanding the deeper architecture of markets is worth your time, then subscribe now. Because what comes next in this video is the part most commentators are afraid to say out loud. George Santayana observed, in a formulation that has survived more than a century of quotation because it happens to be true, that those who cannot remember the past are condemned to repeat it. Silver's history is littered with moments when the paper market delivered verdicts that the physical market subsequently overturned with a ferocity that left the verdict deliverers deeply embarrassed. The question confronting traders, investors, and physical silver buyers at this particular Tuesday juncture is whether 2026 represents a repetition of that pattern, or whether the circumstances are genuinely different in ways that would counsel caution. Let us examine the case against the dump's success with the care it deserves, because the silver market rewards precision and punishes casual assumption in equal measure. The physical shortage story is not a social media narrative. It is documented in the delivery data, the lease rates, the regional premiums, and the warehouse inventory figures of the world's two principal trading venues. At the height of the January 2026 squeeze, COMEX saw a withdrawal of 33.45 million ounces in a single week, a figure without precedent in the exchange's history. London silver lease rates spiked to 30%, a threshold last crossed during the Hunt Brothers' attempt to corner the market 46 years ago. Freely circulating supply in London vaults fell below 130 million ounces. Shanghai inventories declined approximately 90% from their 2021 peak. Only 17% of registered silver was freely deliverable at the squeeze's zenith. These are not projections or forecasts. These are observed measurements of a system operating under extraordinary stress. Now hold that picture in your mind, and then consider what happened to paper prices during the same period. Silver rose, briefly and dramatically, to $121 per ounce. Then the margin hikes hit. Then the algorithmic selling cascaded. Then the Fed signaled hawkishness. Then the dollar surged. And then paper silver came down, hard, fast, and in a manner that produced headlines about the metal's demise that were as emotionally satisfying as they were analytically incomplete. But here is the arresting detail the bearish case must somehow explain away. As paper traders were liquidating their futures positions in January and the price was collapsing, the iShares Silver Trust, the world's largest silver-backed ETF, was simultaneously increasing its physical metal holdings. Institutional investors, the so-called smart money, were using the paper price decline to accumulate physical ounces at discounted levels. The paper world and the physical world were, in that precise moment, moving in opposite directions. That divergence does not resolve in favor of the paper sellers. Historically, it resolves in favor of the metal. But there is something even more structurally significant lurking beneath the current setup, and it is the factor that most casual commentary treats as a footnote when it deserves a chapter of its own. China, which until January 2026 had been exporting between 4,000 and 5,000 tons of refined silver annually, approximately 60 to 70% of globally traded refined silver, has restructured its export regime in a manner that functions as a de facto embargo for all but the largest state-approved enterprises. Only 44 companies received authorization to export silver across 2026 and 2027. The conditions for qualification were deliberately constructed to exclude hundreds of smaller and mid-sized exporters that had long served as the connective tissue of the global supply chain. The effect has been to fragment what was once an integrated global market into regional pools of scarcity, with physical premiums in Shanghai and Asian markets diverging sharply from COMEX paper prices. The paper market cannot print physical silver. It cannot refine Chinese silver it is no longer permitted to receive, and the factories consuming silver, in solar panels, in electric vehicles, in the semiconductor fabrication plants that undergird the artificial intelligence infrastructure the world has decided it cannot live without, those factories will not pause their production schedules to wait for a COMEX chart to recover. JP Morgan's global research team, which is not given to the excitable pronouncements of precious metals enthusiasts, projects silver averaging $81 per ounce across 2026. Commerce Bank's base case targets $90 by year-end. Bank of America has flagged a bull scenario reaching $135 to $309 if physical deficits intensify sharply. These are not the forecasts of people who believe the dump has broken the market. These are the forecasts of institutional analysts who have looked at the supply-demand architecture with the detachment of those who get paid to be right rather than entertaining. And yet, here is where the intellectual honesty this market demands requires an uncomfortable acknowledgement. The risks are real, and dismissing them would be as analytically irresponsible as ignoring the structural bull case. The gold-to-silver ratio, which compressed to 55-1 in May, has expanded back toward 64-1 following the June FOMC hawkish surprise. That expansion removes one of the most reliable valuation arguments for aggressively accumulating silver. Solar photovoltaic manufacturers have reduced their per-panel silver consumption by 19% in 2026 as elevated prices incentivized thrifting and the development of silver-free alternatives, including cadmium telluride thin film technology that, if adopted at scale, could represent a genuinely structural shift in industrial demand. The Federal Reserve's dot plot, as of June 2026, has committee members openly debating rate hikes, an environment that historically pressures non-yielding assets. And the conflict in the Middle East, which disrupted shipping lanes and contributed to oil price spikes in February and March of this year, has introduced global growth uncertainty that could soften industrial fabrication demand beyond current projections. The bear case, stated plainly, is that silver at $63 to $66 per ounce, where futures are trading as of this week, could still have further to fall toward the $60 to $65 range that even cautious institutional analysts have identified as a potential floor. The bullish case asks whether that floor represents a buying opportunity or a warning. The honest answer, delivered without the false certainty that video titles must resist, is that the market itself will provide the verdict on Tuesday in a manner that no analyst, however well sourced, can preempt. What Tuesday will reveal, and this is the insight that every serious viewer of this market should carry forward, regardless of which direction the session resolves, is the answer to a question more precise than, will silver go up or down? The question is whether the sellers, having deployed their most powerful instruments of paper pressure, can maintain their control when the moment of follow-through arrives. Failed breakdowns are not merely technically significant events, they are psychological inflection points. They tell the crowd that concentrated selling, executed at institutional scale, was insufficient to break a market. And when crowds process that information, the crowding of short positions becomes a liability rather than an asset. What happens next could surprise everyone who assumed the sell-off was the verdict. Watch this space carefully, because the next section of this video will show you exactly what signals to track, and which one has historically appeared right before a failed breakdown launches the most powerful reversals. There is a concept in the study of complex systems that the political philosopher in the armchair might recognize as homeostasis, the tendency of systems under sufficient stress to seek a new equilibrium, often with a violence proportional to the distance they have been displaced from their natural state. Silver, which is simultaneously an industrial input, a monetary hedge, a speculative vehicle, and increasingly a strategic material classified by the United States government as critical to national security, is precisely the kind of multi-identity asset that does not respond to stress in a predictable, linear manner. It accumulates tension. And tension, in markets as in physics, does not dissipate quietly. Consider the signals that traders will be watching as Tuesday's session unfolds, because the signal architecture of this particular juncture is more informative than any single opinion about direction. The first signal is stabilization. Not a rally, not a moonshot, simply the absence of continued decline. A market that stops falling after the kind of selling pressure silver absorbed in recent sessions is communicating something important, that the supply of motivated sellers has been, at least temporarily, exhausted. When the paper traders who were forced to liquidate by margin calls have been liquidated, when the stop losses that were queued below key technical levels have been triggered, the mechanical fuel for continued decline is consumed. What remains, if silver holds, are sellers who must choose to sell at these levels rather than sellers who were compelled to sell regardless of price. That is a fundamentally different supply dynamic. The second signal is volume. A stabilization accompanied by thin trading is a tentative stabilization, susceptible to resumption of decline on the next bout of negative news. A stabilization accompanied by elevated volume, buyers absorbing selling at scale, is a structural stabilization, and it frequently marks the beginning of a base-building process that precedes the next directional move. Physical investment demand, according to the Silver Institute, is forecast to grow 20% in 2026 to 227 million ounces, the highest level in 3 years. Global coin and bar demand is projected to rise 18%, supported by a recovery in U.S. buying. When price declines to levels where that demand becomes activated, volume tells the story. The third signal, and this is the one that market technicians describe as the most diagnostically powerful, is silver's reaction to bearish news. If the dollar strengthens further and silver refuses to break, that is a clue. If inflation data comes in hot, reinforcing the hawkish Fed narrative, and silver absorbs the information without continuing its decline, that is a clue. Strong markets do not require perfect conditions. They survive imperfect conditions. The distinction between a dead cat bounce and a genuine reversal is almost always found in how the market handles the next piece of bad news, not in how it handles good news. Now, let us step back from the mechanics and address the longer arc of this story, because the Tuesday session, however it resolves, is a chapter, not the conclusion. The structural architecture of the silver market has been altered in ways that paper selling cannot undo. COMEX registered inventories, at roughly 25% of their 2020 peak, have been drawn down across 5 years of consecutive deficits. The Silver Institute confirms the 6th consecutive annual deficit for 2026 at 46.3 million ounces. Mine supply is declining, not increasing. Silver is predominantly extracted as a byproduct of copper, zinc, and lead mining, meaning production responds to those metals' economics, not to silver's price signal. New mining projects require 8 to 12 years from discovery to production. The pipeline of future supply is not adequate to close a deficit that has been accumulating since 2021. And China's export restrictions, implemented January 1, 2026, have structurally fragmented the global supply chain in ways that no short-term price decline will repair. Against that backdrop, the current dump, however viscerally alarming in its chart pattern, begins to look like precisely what the more measured analysts have suggested. Not a fundamental breakdown, but a reset. A violent transfer of metal from leveraged, emotionally exposed hands into the more patient possession of buyers willing to wait for the structural argument to reassert itself. Physical investment in India alone surged 33% in 2025. Global ETF holdings were increasing even as futures prices fell in January. The smart money, to use the vernacular, was moving in the opposite direction of the headlines. The psychology of markets at moments like this one is worth examining with the same seriousness we apply to the supply-demand fundamentals, because the two are not as separable as textbook economics suggests. When a market absorbs a violent sell-off and refuses to continue lower, the first instinct of the crowd is skepticism. The skepticism is reasonable. The bounce could fail. The base could collapse. The sellers could find new fuel. But consider the position of those sellers as Tuesday unfolds. They have deployed their most powerful instruments: margin hikes, algorithmic pressure, hawkish Fed signals, dollar strength, geopolitical uncertainty, and silver is trading in the mid-60s, not in the 30s or 40s, where a genuine fundamental breakdown would have deposited it. They have fired their heaviest ammunition. The question of whether they have enough left to finish the job is the question Tuesday will begin to answer. And if they do not, if silver, battered and technically oversold, finds its footing and begins to reclaim the levels sellers worked so hard to breach, then the short positions accumulated during the dump become the next source of buying pressure, as covering positions are forced into a rising market. That is the mechanism by which a failed breakdown becomes a launch pad. Not hope, not optimism, mechanics. The same cold mathematical mechanics that drove the sell-off now operate in reverse, and the crowd that mocked the silver thesis is suddenly asking, with something approaching alarm, how quickly that gap can be closed. The rubber band metaphor, though it risks oversimplification, captures something true about the current setup. The further a market is stretched from its structural equilibrium, the more forceful the return to equilibrium tends to be. Silver's structural equilibrium, defined by 6 consecutive deficits, depleted exchange inventories, inelastic mine supply, China's export restrictions, and the relentless industrial demand from solar, EVs, AI infrastructure, and nuclear applications, is not at $63 per ounce. Whether the market takes 6 days or 6 months to rediscover that equilibrium is a question of timing, not direction. Before you leave this video, take 30 seconds to drop your Tuesday prediction in the comments below. Was this dump the beginning of a deeper collapse, a reset before the next leg higher, or has silver already bottomed and Tuesday will be the day the backfire becomes undeniable? The conversation in the comments below will be a fascinating document of market psychology at a pivotal moment, and I read every one. What you have watched in this market is not merely a story about a metal, it is a story about the collision between financial abstraction and physical reality, between the world that can be printed, leveraged, and algorithmically sold, and the world that must be mined, refined, shipped, and delivered to factories that will not wait. That collision in the long run resolves in favor of the physical world. It always has. The only honest uncertainty is the timeline. And remember, this is for education and discussion only, not personal financial advice. I am sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk in mind.